Welcome to Capital Discussions Roundtable. I'm Tom Nunemaker with Jim Riggio, and before we get started, we'll have a little disclaimer. You see it on the screen, the one that's on our website, but just in short, Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations, and the risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. And that's our parrot in the background. Hypothetical computer simulated trades are believed to be accurately represented. Actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that, we're pleased to have Jim talking about hedging your portfolio, and it's a timely topic with the market in decline mode right now. So, Jim, do you want to start by sharing your desktop, or how do you want to get started?
Tom, yeah, I mean, I'll end up sharing some things. I'd be more than happy to. Let me take a look and come back over here. And okay, I wanted to end up starting by talking about when you're trying to hedge your portfolio, what are you actually trying to accomplish? Are you trying to end up, protecting a, let's say, a rather large, position that you end up having? Or are you trying to end up protecting something that's more of your entire portfolio? Okay, they're going to make a huge difference on that first question. There's a second question that we'll end up answering in a little bit, and that is just what are you trying to protect? And so when I take a look at that, it's I think what are you trying to protect? I think of it more as the car insurance or the house insurance type model. You know, what do you want your deductible to be? You know, if your deductible is smaller, if you're going to end up having much tighter insurance on the downside in terms of your put protection, you're going to pay a lot more for it. So overall, it really comes down to, you know, what you're looking at specifically. Let's first talk about what you're trying to end up protecting. Most people end up looking at different types of protection, and I know that there are many folks that have looked at the VXX. For those of you who are not familiar with it, the VXX is a basically it's a pseudo type of ETF ETN that is trying to end up emulating the VIX. And on a day like today, the VIX was up almost 18%. The VXX was up only 7.2. Okay, so there's usually a very, very big difference on that. What I wanted to end up showing you, and let me pull up a chart so that you can end up seeing this real quick. What you're looking at is a chart of the VIX. And you can see going back multiple years about how, you know, we hit our peak back in 2008 and we've come back down. But you can see that our peak was up here at almost 90 and now we're trading at 15.6. The challenge with the VXX is because of the way it ends up working, uses futures to emulate the VIX, which is, in my opinion, it's a flawed model because, and we've talked a little bit about this, you really can't end up using it per se and just buying it straight out. If I highlight just this year, you can see even this little run-up, okay, doesn't even come close to where we were back in, you know, May, okay, or even June. Okay, so it's a bit of a challenge to end up using it. But for those folks that want to end up protecting it because they know and they can see just how much it can end up spiking, if I go back to different periods of time, look at what ended up happening during this section of time. And this was back in April of 2010. Okay, I mean, it can move rather significantly. If I end up showing you other pieces where things had come up, you can end up taking a look at here and look at how far it ends up moving from 260 to 360, 370. So people say, oh, look at how much money you can make in a short period of time. And you can, but you're basically fighting the tide, okay, that's coming in on you. There is one way to play this, though, for those folks that do like to end up using it, and that is to use more spreads. Now, there are going to be two questions. Are we trying to end up, okay, protecting against the modest, let's call it, 3 to 6% type of pullback in the overall market, or are we trying to end up protecting more against a crash? When you're doing that, what you're going to have to end up doing is taking a look and putting on your hedge trade specifically for what you're trying to protect. So if I do take a look at the VXX, what you're looking at right here is a live vol, okay, chart of the volatility skew. On the left-hand side is the implied volatility. On the bottom is the price, or the strikes, if you will, of the VXX. Each one of these lines is for a different date. You can see them encoded here on the left-hand side. So if I hold my cursor over, let's say this is the 35 call that's trading right now with an implied volatility of 103.5. Bid 40 cents, ask 44, and this is for October 3rd. You see the yellow. What ends up happening is that you can see that over time that the calls become much, much more expensive above the money. The puts do lose some of their value, but nothing compared to the way the implied volatility moves up over time. So when you're trying to end up putting this type of insurance on, okay, one way to possibly end up doing it, okay, one way to end up doing it, putting on your insurance, if you're not trying to protect against the crash, but just a modest increase, so that if we went back to that VXX chart, okay, and so that I'm looking for, let's call it, a 10%, 20% move, okay, in the VXX. You can see this was the drop that we had in late late July, early August. Here you moved from mid 26s to the mid, let's call it, say 35 or so. So you had a significant move. So one of the ways you could end up doing this is buying insurance maybe a month out, okay, where you're buying a call closer to the money or a little bit above the money, depending on what your deductible is, and selling one that's much higher. Now, what's going to happen is that you are going to be selling, let's say if we go 3 weeks out or 4 weeks out, I'm going to be selling an IV, you can see up here, that's going to be in the 100 range, and maybe buying something down here where we would be in the mid-70 range. The IVs will get worse against me over time, but if the market does run up, that'll become so in the money. The challenge with this is to be able to end up actually having it in such a way that it'll pay off, because it's much more of a timing way to protect. Let's go through an example. Let me get rid of these. And let's take a look at, I'm using Thinkorswim now to end up actually showing you, because the modeling here is easier. I like the modeling better when I'm looking at a specific live trade on LiveVol, but when you're doing your what-if analysis, Thinkorswim becomes easier than almost anything, because you can click on one and click on another. So I tend to do my initial analysis a lot on Thinkorswim. So if I end up going out, let's say, 30, as close to 30 days as possible, and I'm looking at the 4th week in October. By doing something like buying, and if I want to have insurance that's, I want to try to make money, okay, very, very tight. I don't want to end up having it cost me if we go down. I want to be able to sleep, because I don't want to end up incurring losses. If the market goes up and my hedge loses money, I'm okay with that. Okay, so if that's my theory, one way that I could end up doing it is looking at like buying a vertical. So like, for example, if I end up going and, let's say, buying the just above the money, the 31, you can see that this is trading for about $2, $2 and a penny. You can see that the implied volatility is this column right here is 63.8. Now, by selling something above the money, let's say let's get more strikes up here. By selling, let's say, a 37.5, or even over here, let's get at least a buck. By selling a 36, that means that this hedge could end up making as much as $6. Okay, right? I'm sorry, $5 because I'm pay right. That's the difference between the strikes. That's all that is, and it's 91 cents. That means this has a better than a 5-to-1 payout. Okay, so this is what my hedge looks like. Now, if we do end up having a 5-point jump, okay, which we saw back in April, okay, this ends up paying 5-to-1. Now, what's nice about this insurance is that because the implied volatility is so high, if I end up taking a look at the same trade that, let's say, expires tomorrow, okay, let me just just so you can see a difference in price. And if I end up using the and this is the way I do because it's very quick and dirty, you can see that if I had on the exact same trade, the 31, okay, 36 call spread that expires tomorrow, it's still worth 29 cents. So it holds a lot of its value if you're close to it. Yes, I'd end up losing my entire 91 cents, okay, if I held this, right, my 91 cents, or in this case it's one contract, right, my $91 right up until the very end. But I can end up, I like to end up putting these trades and having them on maybe, you know, a minimum of 4 weeks, maybe 4 to 6 weeks, and then get rid of them with a week left to end up going because there's still a lot of value in them. Like, for example, with 2 weeks left to go, look at that. That's 74 cents. So it doesn't cost me that much to have it on, okay, early on. Now, let me make a very important comment here. That also means that I'm not going to make as much money, right, because this red line is upon expiration. It's not going to happen early on. And the further you go out, the less this will actually move. Okay, so what I found is kind of a sweet spot is if I put it on for more than 6 weeks, if the VXX runs up, I don't make any money. If I put it on for less than 2 weeks, if it does reverse and go down, I've already lost way too much money. Okay, at that point, because the thing is, too much decay would come out of it. Tom, for an initial hedge over an overall portfolio, does that kind of make sense to you?
Yeah, that makes a lot of sense.
Okay. I'm not looking at questions. Are there any questions that we have on that topic? Because I think it's a reasonable way to end up putting some hedging on.
Well, I had a question. Is like, how would you size that based on what you were going to hedge? Do you have any rules of thumb for that?
I do. What I'm going to end up doing is that if this costs me $91 on this side, okay, oh, I have the wrong one clicked. If this costs me $91 on that side, I figure that if the market does go up and come in, I'm going to lose half of that money. I'll lose half of the money. I'll take it off. I'll roll it back on. So from a sizing perspective, what I'm looking at is I'm saying, well, how much am I willing to pay for my insurance? And then I'm going to end up sizing that to be, if you will, my insurance premium, all right, what I'm going to end up paying. And then I take a look at how much money I'm trying to hedge. Now, knowing that it has to go to expiration here, I wouldn't consider the entire $409. You see that number right here? It's going to be next to the red when I hold it. I'm going to end up saying, if we do end up running up pretty significantly, I'm going to end up making money on this thing, but I'm not going to end up making $409. I'm going to probably make, you know, a little bit up front, but in the end, if it's there, okay, after the 5 weeks, I will make the 400. So I'm trying to end up saying, how do I end up spending about, you know, $50 to end up having, as close to a 10-to-1 type of relationship as I can get. Knowing that at expiration, this thing is more like a little bit more than a 5-to-1 type of ratio. So it's basically, you're just weighing how much you want to end up being able to make in your hedge versus how much you're willing to end up spend for it.
Okay. Chuck Martin asked, wouldn't long VIX perform better than long VXX while in contango?
The answer is yes, but if we do get up there, meaning if the VIX does end up going up that far, the contango will end up going into backwardation, and then it'll be a double whammy. Okay, so we'll get paid on both sides for it because people start to end up rushing in once it goes into backwardation. But normally, yes, we can end up looking at VIX after this, and there's a bunch of VIX trades that we end up using sometimes. I want to stick with this before we go to VIX because I'll show you a couple of things there in a second. Any other questions? Because I want to show you two variants of this.
The only other question was why trade the VXX versus the VIX, which you're kind of answering right now.
Yeah, the other thing about the big advantage of trading the VIX also is that it's a 1256 contract, so you have a tax advantage on it also. Okay. Mm-hmm. You also have higher commissions and a lower price on the VIX, meaning that it's it's about a third the price, or about half the price right now, and you also pay additional fees on it, right? Because it's a SIBO only product. Okay. Right. What I've seen here is that there's one of two variants on this. One is what happens if I want to protect against a crash, and then two, I'm a trader, so I think that maybe I don't mind end up selling those really expensive options. Is there anything that I can do to get myself better risk-reward in terms of more of a trade, realizing that the more of a trade it is, the less of a hedge it's going to be? Okay, whereas the crash is going to be more of a hedge and less of a trade. Okay, having said that, let's take a look at a better hedge for a market crash type scenario.
Okay, and while you're switching that, there was a question about what about using derivatives in the same underlying that your trade is in? For instance, how would you structure that, like a RUT puts and a RUT iron condor or butterfly? Would you prefer?
Okay, I can go through that, but that's for single positions. Okay, even if you are using indexes, and that's going to depend totally on what the vol skews look like. Okay, so I'll end up addressing that. Tom, would you just keep that because I don't want to get off track, then I won't get this done. I'll end up addressing both of those after we take a look at these two scenarios. Okay, great. The first one would end up being where I'm worried that the market's just going to, go off a cliff. Okay, how do I end up protecting this so that things would end up making a fair bit of money if it got ever really ugly? Here I want to end up being a little bit longer out. I'm thinking, closer to, say, 45 days or so. And what I'm going to end up doing is that I'm going to sell one call and buy two. I'm going to do it in a back ratio. So if I do something like this, if I end up buying a back ratio, where let's say I'm going to do one in the money and then I'll buy two, see how, okay, let's do it like this. Okay, where sometimes people want it done for free. Okay, what I've seen is that usually free is kind of tough to do. It's usually better off to pay a little bit of money for this. Where what I'm going to end up doing is that normally because of, and this I'm taking advantage, by the way, of the contango comment before, if things do get much, much better and we go into contango, the VXX is going to get crushed. Okay, and it's going to pull back quite significantly. So if I think that the case is either things are going to get incredibly ugly, okay, or they're going to end up getting better. But if they get better, I don't want to end up paying too much money for it. What I can end up doing is doing something like this where I would sell one in the money call, buy two above the money calls, so that if we do run up and the implied volatility goes up on this much higher, what will end up happening is that I'll end up not only making money on this side from the deltas from us moving up, but if it moves up quickly enough, I will actually make money on the increase in volatility in terms of Vega also. The nice thing about this type of hedge is that, I mean, this is the valley of death, right? You can't end up finishing in here. But because we have such high implied volatility on this product, if I end up showing you what ends up happening on, let's go up here, 11 days out. Look at what happens 11 days before expiration, okay? Again, I'm not going to hold this to expiration, okay? I know that even if we just drift around here and nothing at all happens, okay, my loss would be relatively modest, okay? So here I have to put the trade on a little bit longer, 45, 60 days out. The further I go out, the wider I have to make things, so it becomes a little bit difficult if you go too far out. But you don't want this trade on, definitely not in the last 2 to 3 weeks, definitely not in less than in the last week, because you can have just a tremendous amount of decay if you end up falling in here. But if the market pops, okay, the VXX moves up, okay, and this is a trade, by the way, that would also end up working, okay, with VIX, okay. When we run up, though, if we do run up, having the additional contango to backwardation tailwind to help push us up, that would be a great thing because you'll get more, okay, return here. If nothing happens or if the markets calm down and you have a pullback, then the contango will end up pulling you past, okay, your short strike here, so that there's really very, very little, okay, cost. So this is more of a, if you will, an insurance play with that's it's a long shot. It's almost like a lottery ticket in a sense. It's not going to cost me very much, and if the market does crash, nice way to end up putting it on is using a back ratio spread. Okay. Any questions about the back ratios? The next trade.
No questions yet.
Okay. So the last one I want to end up showing on here is going to end up being more of a butterfly or a broken wing butterfly to end up having the insurance factor on it. Again, I'm going to end up being out maybe at least 30 days or so. Okay, and remember, okay, when we looked at what that skew looked like, and let me come over here just again to show you. When I go out 30 days, I'm looking at a skew here. I want to sell, okay, I want to end up selling, if you will, the meat. Okay, I want to sell something that's pretty expensive. Even though the vol is so high here, if I buy a cheap enough put, like if I'm only spending 10 cents, I'm sorry, a cheap enough call. If I'm only spending 5 or 10 cents or 15 cents, I don't really care how high the volatility is because the option's so cheap. But I'd like to be able to sell something that's a little bit more expensive. Let's say, that 75 cents or $1, okay, and get a lot more premium. So the way I would end up doing that would be the following. I'd come out here and I'd take a look and see how far I'd end up protecting out. Here, let's take a look at maybe going out to the 37.5. Buy a deep and wide butterfly. Maybe I end up buying the, I said 37.5. 37 will work also. And I want it to be cheap enough so that maybe I can end up, maybe go to 30. We go up 38. That's 7 points. Maybe you make this side 5 points or so. 6 points. Okay, so for a 67 cents, let's go just to expiration. Okay, so here is another trade where if, again, I'm timing this, and I probably should have gone out a little bit longer because it's a little more. Oh, let's go to 45. Trade it. Trade it. The monthlies will be traded, though, definitely. Okay. No, that's a little bit too expensive. Okay. So if I stay here in October, I've purposely made it a broken wing. Yes, I can kick this thing out maybe to 45, and if I kick it out to 45, I drop my insurance by 12 cents. I'm thinking, is this more of a trade or if it's more insurance? If it's more insurance, I'm paying the extra 12 cents. And what I'm doing is that I'm buying a call close to the money, and if you take a look, let's take a look at the strikes, right? Buying the 31, okay, okay, I have the right one here. Buying the 31, I'm paying just under 70 volatility, right? It's a little bit in the money, but then what I'm doing is that I'm selling a lot of juice, okay? Meaning when I come up to the 38 right here, and that's here, while we bought the 69, I'm selling an 89, and I'm selling twice as many of them. Right? So I have volatility on my side when I do this. When I buy the 43, I know that I'm paying a much higher vol, but here I'm only paying, half the price for that longer strike. Okay? I'd like to put it out further, but the tail, okay, on these things is so expensive that it's going to cost you money to end up buying that. But when you take a look at what my cost is going to end up being. Now, this one, if we do get crushed in VXX because the world peace breaks out tomorrow, I'm going to lose $75 a contract. But it has the possibility. Now, never, ever, ever look at the peak here. Okay, because, Tom, you've heard me say this. The chances of you finishing at the peak of that butterfly, you got a better chance of getting hit by lightning on the way to cashing in your winning Powerball ticket than you do to land that butterfly.
Right.
Okay, but could you, if we run up, okay, is this number very reasonable? It's reasonable. Now, remember, if we run up, volatilities will go higher. The higher the volatilities are, the further you'll be pushed down. Like, for example, let's put this strike here at the peak, right? And the peak is 38. So what we're going to do is that we're going to look right here on this strike. And if I hold my cursor over here, it says that I'd make $125 approximately. But if we run from 30 to 38, chances are the implied volatility is going to go up. How do you model that? You take a look at the implied volatility and you bring it up 5 points. Okay, so now when I hold it over here, yes, over on the right-hand side, you still see my 125 bucks. But you see, when volatility goes up, I'll actually make less money. So this trade is more about it's a trader's trade in the sense that it's putting the insurance on, but not only do you have to end up having the vols go up, but you have to go up and get there close to expiration to make significant amount of money. Okay, so it's a much more difficult trade. One of the things that I end up always telling folks is the best way to think about this is that when you're under, okay, the peak of your butterfly, as volatility goes up, that's going to push your T plus 0 line or your current P&L is going to be lower than what the graph says, okay? And that will end up happening to you. If you end up going past it, let's say we come up to, 44 and you haven't taken it off, if we come back down at that point, okay, as we come back down, volatilities will go lower and you'll get sucked up into the butterfly. So being out here, a week beforehand, you have a high probability of being able to make some decent money, because if it does pull back, okay, again, you have the two things helping you, both the volatility and the delta, in addition to your theta. So it's a trader's trade, but in terms of how would I end up doing this? I don't view this one really as much as protection, as more of I'm trying to end up making money in a bear market. This one isn't going to end up having the same type of immediate payback, unless, very important, unless you end up timing it so that you do end up finishing anywhere close to 38 as you get in that last week or so of the trade. Three different ways to end up addressing your overall portfolio for hedging. So sorry about that. Tom, any other questions?
No new questions. Nope.
Okay. Anyway, so those would be three things. Tom, I didn't write down all the other questions about what would I end up doing in an underlying, like if I was in the Russell. Right, that was one of them. Let me show you this again. When I take a look at the Russell, okay, and I'll take a look at these are the ruts. Now we have way too many strikes here, but you can see how different this ends up looking like, where we have a lot more room on the downside, where we have the other side was called a call skew, because as we looked in the VXX, okay, the right side had much higher implied volatility. Here, the left side has much higher implied volatility. So if you're going to end up using, and you want to end up using your specific underlying that where you have your highest correlation, what we end up doing, EAB Investment Group is a company that I have an affiliation with. And what they end up doing is that they build hedges for very large money managers. Okay. And what they will end up looking at all the time is what the skews look like. When they go to hedge somebody's portfolio, the very first thing they do is that they run correlation analysis on a whole bunch of different time frames. Then they end up saying, well, what index or what ETFs would end up making the best mix for, their portfolio. Maybe it's 50% S&P, 20% Russell, and 30% financial services XLF index. Okay, I'm just making that up. But they'll end up having some balance of this is the closest representative that gives us, at least a 94% correlation. So if you're going to end up using things like this on correlation, again, you're going to want to end up using your implied volatility, okay, in your favor. And you're going to do three similar types of trades, right? You're going to take a look at verticals. They're going to cost you a lot of money, though, if you're wrong. You're going to take a look at maybe below-the-money butterflies. They're really, really nice. If you can come anywhere close to that short strike. And you can look at back ratios. They tend not to end up working as well because you don't have the, if you will, the double whammy of having the contango turn into backwardation to end up really helping you. So that's more of a challenge. But you can end up doing that on this type of a trade. You can also end up selling covered calls to be able to end up helping to pay for it. What we tend to end up doing is that we end up having a proprietary methodology where not only do we use back ratio type of stuff in varying quantities, but we also end up using it in a multi-month mode. So we can then take advantage of the term structure or the different levels of decay. But it's a very, very strong way of being able to end up having your hedge. The most important thing that we end up building on our hedges, okay, for large money managers, is that we always want our vega to get larger as we go down. That's a very important statement. You must be long put contracts to be long vega, so that if I was to end up showing you, let's just go to the rut. Okay. And if we were to go out and buy, again, let's buy something maybe just 35 days out. If I was to buy a vertical, right, I'm just looking, right, and this is the way I'm doing, the way I do it very quickly, right, at least just to get a feel. What we end up doing is we actually run mathematical models to end up saying which one's going to end up giving us the greatest probability. But when you end up doing it by eye, if I end up doing something, there's a half a point here, volatility goes, so maybe I end up even going to the 120. Again, this is, I don't want to end up spending money if I end up, see, I can end up getting my volatility to go up, but not quite as much, right? Not quite as much. It's going to be too expensive, right? Still, see, the problem is that building it with just even verticals is very expensive, right? You can end up taking a look at what my cost would end up being. It's protecting me about 8% down, but it's going to cost me $20. Way too expensive, I end up thinking. The problem is that if I try to end up doing it with other strikes, if I go for, say, from 1100 to 1050, right, I protect 50 points, I still don't have the risk reward that I end up liking in something like this, which means that I tend to end up leaning more towards a butterfly or a broken wing butterfly or a condor. If I ended up buying something like a condor here, let's just get this a little bit closer. And I'm just looking at trying to sell higher volatilities and not spend as much when I have to end up buying everything back in. Okay. Again, something like this, will end up decaying. I'm trying to sell more premium. Maybe I could even get it to be a little bit cheaper and move this up a little bit more. Okay, so something like this ends up being a, right, I had both of them on. Okay, I had both of them on. Helps, and if I'm going to do it just with just the condor, maybe something, and let me come up here. Okay, something like this, but now I'm still, this is not disaster insurance, right? This is great for the, 5 to 8% pullback, but if we go down 12, it's in a lot of trouble. The problem is that if I end up bringing this up so that I'm not in trouble if it ends up going down, you can end up seeing that my cost goes up rather significantly. So everything you end up doing in terms of putting on your insurance, you're going to have to trade off what area am I trying to protect over what time, and how much is it going to cost me.
What do you think about the concept of people buying those teenies, like on the Jeeps, where they buy the extra long puts?
I think that most of the times it's a complete waste. If you do your back testing during 2008, where you have these unbelievable drops in the market and the volatility go through the roof, they will make money. But the problem is that they only make money, once every 10 years.
Right.
Okay. Now, when they do make once every 10 years, when they make that money, they make an awful lot of it. Okay. But the challenge that you end up having with the teenies, and I've looked a lot at this, the teenies are way out here. So if I'm buying the teenies, let's say a month and a half out, okay, I'm buying the 900s, okay, for example, at, and some people might even pay more. If I'm over here buying the 960s, but that's not enough time, that's only to the 10th. Here, if I go to November 7th, where would my dollar, okay, and that's what I know a lot of people sometimes like to end up paying somewhere around there. I'm buying a 900. Look at how much higher that volatility is, right? I'm already paying a 31 vol compared to, vols, okay, near the money with less time are in, around 20. So I'm paying a much higher vol. So my probabilities are that it's not going to happen very often, but when the market does full out crash and volatility goes through the moon, there is nothing better. But the problem is, like I said, that doesn't happen very often.
Right.
Okay.
Brad Hartman had a question. He said, or maybe a comment, due to contango, VXX will go to zero over time. Would you consider the last fly in VIX or another vol product instead?
Well, yes, the thing is that's why probably the trade that I like most, Brad, if I'm going to use the VXX, is that I do end up putting on something like this. Okay, if this is to help to protect the upside, something like this, because it's going to go to zero over time. But when it does end up moving up, it can end up moving up significantly, and backwardation will actually make it go higher faster. So an above-the-money butterfly, okay, are extremely cheap to end up putting into this. If I didn't want to end up paying for it, but I still wanted to have some type of insurance, okay, if we went up, but again, not a full-blown crash, I could do a broken wing, okay, so that my cost was very, very small. But again, this is a timing thing, right? So that if we go up immediately, this does not end up helping me. Okay, this is a timing thing. Whereas if I'm worried that, there's a bunch of things that are coming up, we got, FMOC, okay, announcements. We got issues in and around the ECB in Europe, okay. Don't know what's going to happen in the Middle East. And so I'm worried that vols can end up actually exploding. If that's what I'm worried about, then doing my back ratio and paying a little bit for it, okay. So this way, if it does go down, and I'm taking advantage of, in this case, if it does go down, which I expected, that's why I'm selling in the money, okay, call. Some people try to end up doing this so that they sell the in-the-money call, and they actually try to end up doing something like this where they collect a couple of dollars. You can end up doing that, but what I found, what happens most of the time is that this area can end up hurting you. Now, if you pull back, you will make money, because let me show you the day step on this. All right, the day step is that if we end up pulling back, okay, it really doesn't cost me anything. And this is really just catastrophic type of insurance. Okay. Were there other questions, or would people like to end up seeing what happens if you do this in the VIX?
Yeah, no more questions, so maybe a VIX example would be good.
Okay, let's, where does everything start? Okay, for me, everything always starts with looking at vol skews, okay? And I'll take a look at live vol, because nobody does a better job, in my opinion, okay, on the vol skews than the guys here. One of the things that I didn't show you is that I can go back and take a look and see how the vol skews have changed for 2 years. Now, I'm not going to do it right now, because it's pulling in every single strike, every single bid ask, every single IV, okay, for every single expiration for every day over the last 2 years. So needless to say, it takes a little while to load that much data for you. Okay, but here, if you take a look, my skews look a little bit different. One of the things that I will tell you is that you cannot model VIX trades on Thinkorswim, okay? Because of the way that the VIX options are priced. The quick and dirty way, the way traders often think about it, is that we often say that the VIX options are traded off of the VIX future and not the VIX cash. And that's at least 80% right. If you get really technical about it, it's what the options are for that specific expiration on the SPX, which have a very high correlation to the VIX futures, but it's not perfect. Okay. So when I take a look here, what I'm going to be doing is that if I was to buy verticals, okay, and I've done this, like for example, one of the verticals, and Tom, I don't have option view handy, but I can end up telling you in one of the accounts what we had done is that we had bought a 1323 option on the VIX that expires, okay, in October. So it looks like this. Okay. And when we bought it, we paid $1. Actually, $1.05. Okay. So you can end up trading something like this. Again, now, this was more of a hedge, and we weren't using it for timing. Had I been using it more as a trade, I would have done something similar. I can't end up showing you now this. It's too far to go out. The problem is that we're in between strikes, but when this ends up working its best. You know, you need to put this on probably closer to 40, 45 days. I have 54. I'll show you on 54. So if I do something like this again, buy deep and wide butterfly, okay. Yeah. Putting on a trade like, by the way I'd end up doing this, and I can end up and show you, but if I come and I draw a line over the last couple of years, you know, 20 to 23 has been the range, right? If you end up having a really bad spike. Okay, so when I come back here, I'm going to end up maybe selling the 21, okay? Or if I want more protection to the upside and I want to end up paying, maybe I sell the 22. If I want to make this more, right, this give me more protection to the upside. If I want to make this more of a trade, maybe I'm selling the 20. Okay, now I'm selling the 20 because I'm really not worried that, let's say, if the VIX goes, you know, to say 23, 24, not that big of a problem for me. I don't think it's going to go up there. Then I like this trade. If I'm worried about the market and I say, oh my God, you know, it's going to be worse this time, the market's going to end up going much higher, then maybe I end up putting something like this on, okay? Or even if I'm really, you know, ultra paranoid, I put on something like this where I'm going to get a lot of that gain very quickly, but it's going to cost me more if I'm wrong. Now, don't forget, okay, what ends up happening is that you do have an issue with, you almost have the same issue of contango when you're using this, because let me show you the VIX futures. If I go out further, right, the green and red line is the cash. You can see obviously the cash jumped pretty a lot today. The pink line is the front month. Okay, that's the Y4. I don't know if you can see it over here. but this is the Y4 contract. Okay, and the Y contract is the Y4 contract is October 2014. And then the next one, okay, is November and December. And so you can end up seeing that the vols, where they are, the implied volatility, and where they end up trading, the futures. One of the things that we take a look at is how close is there a difference, and what contango basically means is what's the difference between the front month and the second month. I have another one that I end up using, okay, where I actually chart the spreads. And over here, the green line is the difference between the front month and the second month. So here what I'm doing is that I'm subtracting the October from the September contract. Oh, I'm sorry. Did I say? No, I meant the November from the October. So it ends up showing me that in real time where history is. By the way, what this number is, it's basically, it's a very similar thing to what some people look at VixCentral.com. Right? I like this because, number one, it's real time. I can end up doing it. It's real simple, by the way. Anybody can end up doing this themselves. All I ended up doing is that I ended up plotting, and they're the two contracts. Right? So I just minus the X contract minus the V contract. The X contract is November. The V contract is October. And if you take a look, what I keep is the yellow line is the second month, and that takes the December contract, which is Z, and subtracts the November contract, which is Y. Okay, and this way I just keep them all plotted so I can end up seeing what's going on. So we're not in. Oh, let me come back. We're not all the way to the right. Right, we're not in backwardation yet. So you know.
Now we did have the cash did get more expensive than the October, but do you read anything into that?
What happens is that there's a lot of noise in the cash. Because what ends up happening in the VIX cash is that it's influenced so much by, single orders and where they come in and what price did, certain strikes come in. It can end up being moved by even multi-leg trades. Which legs were you long, which legs were you short. So there tends to be a lot of fluctuation in it. I leave it on there because I want to know where it is, but I do realize that most of the time it's noise.
Okay.
The VIX futures, on the other hand, are going to give me a much more steady and reliable look at the market.
Right. We did have a new question. Chuck Martin says, please compare 13 VIX combo, long 13 call plus short 13 put to your long call vertical.
Oh, so he wants me to, okay. Basically what you can end up doing is that you can end up using a combo, which is just buying and selling the same strike. Okay. So what ends up happening in something like here, and let's have this so that let's take a look at reasonable ranges. 10 to 25 seem reasonable?
Yeah.
So what ends up happening in a lot of these things is that if the market moves back to, let's say, we've had, closes on the VIX futures. We've had some really significant futures. Like, for example, let me do this. Let me just show you where it's closed the last few months. Let me come just here to basic so that we don't have all of this other crap in here. Maybe you guys don't know this. Anybody know the symbol for the VIX settlement price?
Oh.
Okay.
Yeah, I'd have to look it up, but yeah.
Anybody trying? I mean, you get to be called a VIX geek like me then.
Is
Okay.
it
If nobody
DXO
wants,
or?
very close. VRO.
VRO, there you
Okay.
go. I knew it had an O in it.
Okay, so if you end up taking a look at over the last couple of years, kind of interesting, right? We went up to 23 and change. We've never had a settlement price above 17.
Interesting.
Right? Very interesting. So here, I'll show you one other thing while we're here. You guys responsible for your own trading. I'm not responsible for your trading, so you can do it any way you want. But if I end up doing this and I end up adding a study, right? Let me come over here. Studies, edit studies, compare. And we're not going to end up putting it over here. We're just going to do a line, and we're going to do VRO, apply. Okay. Now let's take a look at this. Okay. All I did was take a look at what happens in most days, right, in most months before expiration. The day before, the week 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 before. I'll go back. I'll find one when we went up the week before, but it's kind of hard. Oh, here we go. We have one here. What was this, a year and a half ago? Okay. Just the way there is downward pressure, I'm sorry, just the way there is upward pressure on the VIX and the RUT going into settlement, there is downward pressure on the VIX contract. Okay, so you guys use that any way you want, but that is a very strong tradable idea. Brad, you hear that one? Okay. Going back to what we were looking at. Okay, now here's the combo. So what ends up happening is that, and what I'm fearful about keeping combos, and the reason why I showed you that is that if we run down, and some people think, well, I'll just keep the combo into expiration. I don't like combos into expiration because I found that at least for the last year and a half, I don't think I've got a good settlement once. Okay, with it. Whereas if I end up taking a look at the vertical, okay, I'm protected on the downside, and I'm risking much, much less to end up making, more. Instead of the 13 that I put on when we were lower, okay, if I was doing this today, maybe you end up taking a look at, and again, if you're protecting, do you do the 15? Okay, take it out to November. Okay, it's a little bit tough when it's already high, right? I love the vertical when the IVs are already, when they're very, very low. When they're higher, doesn't work as well. Okay, the problem with the combos is that when we're higher, we have a longer way to fall also. I tend to end up thinking that, when I'm at 12 on the VIX, I do have to protect what happens if we run up a lot. But if we're already, let's say, at 15 or 20, now, yes, can we get to 23 or so? Without question. But after you have a run up, because the VIX does tend to be, the VIX has greater reversion to the mean properties than any other security that I know of. Okay. And so when we play for that, it's one of the things that I'll take a look at. I'm very, very, fond of trading, butterflies on this, and doing it in such a way that I'm not risking a tremendous amount. I'd rather end up having a butterfly on to be able to protect, again, for an upside move, but maybe not something outrageous, maybe say to 21. Okay, to me, that's a nice trade that ends up protecting to the if the VIX moves up. I have some really nice risk reward, and I can end up playing, realizing that many times the VIX does pull back in the last week, and the challenge with any of these trades is that if they're that deep into the money, meaning that if we're up in the, let's say, 20, 21 range a week beforehand, let me show you that. We're here, say, 2 weeks beforehand, okay, you have a fair bit of money, okay? If you're here 2 weeks before or a couple of days before expiration, I forgot who it was, but one of our compadre traders ended up saying, trying to balance a marble at the peak of a mountain, right? Very, very difficult. And if it moves a good chunk of what you've made, you can end up losing. So you do have to be very diligent and disciplined on being able to take the amount of profits that you think you end up needing, or that your system would end up saying over time.
Yep.
Okay.
Although I think your analogy of a marble on a mountain, the mountains are usually pretty big, so maybe bounce a marble on a basketball or something.
Yeah, and at expiration, it is the mountain, right? At expiration, It is the mountain. So those are nice trades. I tend, and again, the trader in me says, you know what, if it runs up, I'm making money. If it's more of a trade, I'm doing this more of selling maybe the 20. Because, and the reason why I like certain trades is that if we are going to end up running up, I kind of have to go through my profit zone before we get to my high risk zone, okay? That was something that an old SIBO trader taught me many years ago, that most of his trades were set up this way where in order for him to get to his biggest risk, he had to go through his maximum profit zone before he got to his maximum loss. I like those trades. Okay.
Yeah,
I don't think I have a lot of risk on it.
Yeah, many traders at the CBOE live by a 1x2, where you sell 2 and well, it's basically like that with unlimited risk. Yeah.
This is a responsible 1x2.
Yeah, that's a defined risk 1x2. Yeah.
Okay. But by the way, what all Tom is saying with the 1x2 is not to end up selling and not to buy this last one. If you take a look, it's 55 cents. If I do it this way, if I come over here and I say custom, not over here, and I say custom, and I bring this quantity down to 0, it won't let me do it if it's 0. I have to I thought they'd let me do it. Let me go back to making it 1, butterfly, and let me do a 1x2. What were the strikes? 15 and 20. Buyback ratio. Boy, is that cheap. Look at that. 55 cents you saved. Oh, hang on. I did that backwards. You're still saving 55 cents. 0 from 0 is still 0. So over here, maybe what I do is, 22. Okay, this is almost the same thing, right? A debit of 55, a debit of 50, but over here I don't have any long. Now the problem with doing this, I love these trades. This is a risky trade. If, we have any type of ugly situation, okay, you don't have enough delta in here, okay? If you're going to put on these trades, okay, what I'd rather see is to have some positive delta. You can't do this out in November. You could do it in October, though. Because in October, if you take a look, see where my deltas are? I'm positive 18 deltas. If I go into, I'm only 4, almost 5. I don't have enough long delta to be able to end up reacting.
Yeah, you gotta let some time pass for that.
right? You have to let some time pass to end up going. Now, by the way, you're still in, a boatload of trouble if we end up having, any type of, financial crisis type of meltdown.
You'll have your own financial crisis, yeah.
Anybody, please, realize the amount of risk you're taking if you're doing that. I'd rather see folks do the responsible 1 by 2. I go to bed and I sleep well with this trade.
Yeah.
I got defined risk. If it goes out, if the world ends, I know my risk is protected. I stopped at over here, but remember where we went? We went up to 90 during the financial crisis. So we wake up tomorrow, I lose my $251 per contract, times how many ever contracts I put it on. I'm okay. The 1 by 2 guy, he's over 6,000 per contract.
With no stop in sight either.
With no, oh yeah, that you're in a nosedive.
Yep.
Right, nosedive, tailspin. You ain't pulling the nose up on that one. You're crashing and burning.
Yeah, we had a rule in the Air Force: if we were out of control below 10,000 feet, eject, and that's kind of where you are without a parachute, though.
Yeah. Not a lot of good scenarios when that happens. Okay.
No.
Here, $255, I can deal with that. 6,000 per contract? No. Okay. So, again, this is more of a trader's trade where I think that we're going to end up going, and the worst thing in the world, by the way, is you put on these trades and the VIX goes up tomorrow in a huge way. And what ends up happening is then vol ends up dropping. So if I end up showing you here what happens with vol steps, okay, and I'm sorry, vol increases if we end up going up in the VIX, right? And so what happens where I thought I was going to be making money, all of a sudden it's like, wait a second, we got up to 20, we got up to my sweet spot up here, right? I'm going into my short strikes and I'm not making any money. The exact same thing happens on the downside if you're going to end up using the rut. For those of you who ended up asking, Russell 2000 or S&P questions, I was worried, during the flash crash, what was going on with Europe. If you remember, there was the whole thing in and around the ECB. So I end up thinking, oh my God, look at this great wide butterfly. The put skews were so high that I put on this really, really cheap butterfly below the money. During the bottom of the flash crash, we just got about to my short strike. I didn't make a dime on that butterfly. Not a dime. Okay, volatilities went up so high. What happens if instead of 5 points, now remember, this is not 5 VIX points. This is 5 points on the VVIX. Remember, the VVIX is the VIX for the VIX options, right? So they end up trading a lot of times. In case you guys don't know what that one looks like, let me show you real quick. VVIX. Okay. Not uncommon for the VVIX to get above 100.
Right.
Okay, an implied volatility over 100. We're at 96 right now. What happens if we spike to 120? What happens if I end up taking you back? It doesn't go back further. But, much higher during financial crisis type times. So now when I take a look at, if I put back that VIX trade, this takes me down 20 points. Okay, even if we run up, and I thought it was a good trade, right? I thought I was going to make money if we ran up. No, not necessarily. Not if it runs up too quickly and the implied volatility goes up too high. So it really is a timing trade.
Right. We have one last question from Chuck. He says, what's the maximum value of the VIX? I don't think there is one, is there?
There really isn't a maximum value on the VIX. What we end up having is that we have history. We think that if I go and I show you the maximum value of the VIX during the financial crisis, we were up in the 90s. Well, just in front of it, if I come back here, you can see that we got just short of 90. But, I mean, I want you to look at how long we lived above 50, right? Look at look at these ranges that we had during this time of October and November. Everybody remember, September, October, November of 2008? Yeah, it's hard for me to see stuff because I was hiding under my desk most of the time. Right? It can stay up there for a long, long time. Okay, and by the way, one of the things is that we don't have, right? We don't have history of the if I come back here, take a look at what ended up happening here. Here, they only brought the the VXX. They only brought the VXX out in February of 2009, after we ended up having the really ugly run-up. Okay, by this point, things were starting to get better. If you remember, we had an up January. Okay, things looked like they were starting to get better, and when the product came out, comes out at 40, 40, comes out at you have to look on the right-hand side. Okay, comes out at 6,400, runs up to 70, almost 7,700. Now, granted, that's adjusted for splits, but runs up huge in the first month. Then trade sideways. And then everybody knows what happens after. Okay, we hit our bottom in March, and then after that, we really slid down. It starts its precipitous slide down. But make no mistake, when things get ugly, okay, and this thing goes from contango to backwardation, it can just absolutely rip. There are trading systems to end up trading the VXX, and its inverse, which is the XIV. There's trading systems on OptionView that do a reasonably good job. It's probably one of the best commercially available ones that I've seen. We end up trading one in a proprietary hedge fund that I end up working for that it's somewhat different. It uses different calculations, but again, it ends up showing you when not to end up getting in. The one thing that I'll share with you the chart. We don't sell the indicator, but I will share with you the chart that we end up using, the RVOL. And so what we ended up finding is that if I come back over here and we go back as far as we can, like for example, if I take a look at the budget crisis. Okay. By the way, isn't it amazing? I mean, let's give these guys some marketing kudos. I mean, the guys at ProShares and the Credit Suisse guys, they're great business people. When does the VXX come out? The answer is they build it as quickly as they can after the financial crisis, and it comes out, a couple of months later. What happens over here? This was the budget crisis where they weren't going to end up raising the ceiling, and were we going to end up defaulting on our debt, and the U.S. got downgraded by Standard & Poor's. Remember all of that? After that, and people make all of this money on VVX, what do they come out with? They come out with the UVXY, which is the 2 times the VVX, right? The VXX, I'm sorry. So their marketing and their business sense of when to end up selling stuff to retail people, absolutely great. I mean, they really are great salespeople, great product. Let's find a sucker to sell them to. So.
I think
I'm a little bit jaded.
Adrian had one last question. So to hedge $100,000 of SPY, how many of the VXX back ratios one must use every month with no deductibles?
With no deductible. Let's take a look. So what ends up happening is that you have to end up going and doing your ratios. Okay, but I'll tell you that you know, if the market ends up pulling back 5% or say 10%, the VXX is going to double. Okay, take a look, do your math, okay, and I want you to end up being comfortable with your range. But if you wanted to do $100,000, if I'm coming up to 60, okay, and I take a look at, let's say somewhere between 70, let's say it goes up to 70, be a little bit conservative. That's about $3,000, right?
So if you're looking at a 10%
if you wanted to do $100,000, right?
Yeah, you're trying to protect 10,000 in loss.
Yeah, right. If I do 35 by 70. Okay, so I have to protect about $100,000 in loss if it comes down here. Okay.
Well, I think you said $100,000 of SPY. I don't think that would be the loss. Maybe like a portfolio of 100,000. So I think if you're protecting, protecting, that'd be maybe like a $10,000 loss.
Okay, I was doing $100,000 loss. Okay, let me go here. So if I do a 4x8. Right, so I'm going to have about a $10,000. Okay, now this is tail protection. Right, 4x8. I did it. This is done for a small credit. Okay, you know, I did the 28 and the 30. You know, I could end up moving it up a little bit. Okay, it's probably a little bit too high, but if I did the, let's say the 29 by 35, I'd rather do that. Have it a little bit closer. It does cost me 10 cents. Okay, but again, if I get into that, you know, 60 or above range, from 60 to 70 is where I'm going to make my my 10%. So, you know, maybe if I did it here, maybe if I would do 5 by 10. Now I'm at 95,000 as soon as I get to 60. If things get better, right, it doesn't cost me practically anything. Right. So nice. How do you end up picking your strikes, and where do you end up picking? What I end up doing, and I couldn't live without this, is that I come in, I'll take a look at where the vol skews are. I'll look on VXX. I'll end up going out, getting rid of all of the junk that I don't want to see. Let me go out 50%. Okay, and now I'll end up picking my strikes from here. If I don't know how steep this is, I'll go back and I'll play it for a month, I'll play it for a year, and I'll actually end up watching how the vol skews have ended up moving. Okay, I'll actually watch and see what they've moved and how much they've ended up moving in terms of how steep they've gotten, how high the implied volatility is. And you can see here, it's just kind of going through, okay, the different months. You can step it, you know, day by day, so you can end up taking a look at, let me get rid of September. And so I can take a look and see, you know, how steep things have gotten and how bad they are. And what I'm going to end up trying to always do is that because it's a back ratio, right, where I am selling lower and buying higher, I know the vols are working against me, but what I'm trying to do is that in the trade, I'm trying to end up using the natural contango of the product to end up saying, well, I don't want it to cost me anything if it goes down.
Or very little.
Remember, you can't, right? Remember, you can't keep this thing on, okay, in the last, if you're in here, you really can't keep this thing on late in the trade. Okay, you can get really, really hurt. Also, if you've made your money, okay, at some point, consider taking it off and re-hedging it again higher. So this way you're protected again.
Makes sense. Well, Jim, I think that's about it for the questions.
A lot of questions.
Yeah. We went a little long, but it was an important topic, and I think a lot of people got a lot out of it. So thank you very much, Jim.
No problem. I was glad to be able to end up helping. Tom, why don't you end up telling folks what's coming up, and if they have any further questions, where they can get in contact with us.
Okay, sure. Well, we have email support at capitaldiscussions.com. As far as the upcoming things, we've got, I'm having to rearrange the schedule a little bit. Tony Sizemore is going to speak next week. He was sick this week and couldn't speak. The week after, I think I've got Larry Richards with Quanti Carlo coming on. He's going to talk about their automated backtesting software. I think they're planning on a short public beta or user trials at the second half of October with a commercial release in November, early November. That's the target dates. And then we've got John Locke and Joe Cusick, who used to be head of education at Options Express. So those are kind of the lineup for the next month or so with the roundtable.
And on Mondays, we'll continue to end up doing our weekly analysis. We'll take a quick look at the macro, but then we spend a lot of time with the market technicals, looking at all of the major indexes.
And if anybody listening would like to come on and be a guest and talk about their trades or have questions, then we'd be more than happy to have you on. So just let us know. Support at capitaldiscussions.com to send us an email.
Thank you very much.
All right. Thanks, everyone.